Hello everybody. So today I wanted to make a quick video about ON Holdings, known as On Running. Their shoes, their company that makes running shoes. Interesting company. What can I say about this company? Well, first of all, it's a hyper growth company, so that's why I cover it on the channel. But a few interesting things. It was founded in 2010, so actually the brand is fairly new. It's 14 years old. It went from 0 to 1.8 billion in sales in 14 years, so that's really not bad at all for a consumer brand. That's actually fairly impressive. And they're operating in the running shoe business, and that's a competitively brutal market place. Very brutal, but also very large total addressable market. There is no denying that there's plenty of room for so many players because we all need shoes, right? We all got feet, all 8 billion people of us. And so these are the premium shoes that they try to sell. They are definitely putting themselves in the premium market in premium segment of the market at about $160 for a pair of running shoes. So that's quite expensive. So what is it that I like about this company? Well, first of all, it's a direct-to-consumer company. It's got distributors, but they do a lot of DTC sales, which is something that a company like Nike, for example, has a hard time doing because they have long-time distributors and they wouldn't want to undercut their distributors. Well, this is not as much of a problem for On Running, who has a very large share of DTC sales, especially China. They mentioned China is 100% direct-to-consumer for them. And direct-to-consumer, the share of them selling these products direct-to-consumer is growing as they sell more of these shoes on their website, but they also open company stores, and these company stores really increase direct sales to consumers, which means you get a higher margin. Latest call I listened to, the CEOs mentioned that one single store, the London store, actually would rank as the 5th country in Europe for them if you were to just count that store as a country. And this is very bullish on the stock because their strategy is to open more and more stores, and these stores seem to really foster way more sales. Another thing about the growth runway of this stock is that it's still a largely unknown brand. In fact, before many of you brought it up in my comments section, I had never heard of it. It's still largely unknown. The awareness is very low. It's nothing like a Nike, right? Nothing like even more famous running shoes like Asics, etc. It's awareness for this brand is extremely low. So what do I like about On though? Well, the main thing that I like about On is of course the growth, and they've guided. So their latest call, if you listen to their latest call, they have guided 100% growth over the next 3 years. So 100% over the next 3 years is actually about 29% a year. That's roughly within my threshold of 30% per year. The fact that they've guided this for the next 3 years makes me very happy to own this stock because it removes a lot of uncertainty in the future to have this long-term guidance 100% over 3 years. That's very reassuring. There's other things to be excited about this stock, but I like about this stock. They are investing a lot in the Paris Olympics, and of course running is a cornerstone at the Olympics, and they hope that their brand becomes more internationally recognized and gets more international appeal from people watching the Olympics. So the CEOs are very excited about their presence in the Olympics and how they are going to be able to be seen, worn by all sorts of athletes of all kinds, and not just Swiss athletes. And so I would understand why in athletics the Olympics is such a big event and such a big way for them to promote themselves. In fact, a lot of companies are betting on the Olympics. If you follow Airbnb, Airbnb is also awaiting the Olympics to push its brand and to do a worldwide push for its brand. The last thing I love about On and On Running, and this is something that I often complain in small firms, is that they can be easily acquired. On running has a very unique governance structure. It's got a very Swiss ownership structure with 5 members that own the company, and this makes takeovers very unlikely for this company. And if you listen to the CEOs, they actually very clearly talk about, making a multi-decade company and investing for the next decades and being in it for the long run. So that's reassuring if you buy a stock that you want to own for a very long time. So what's so special on ONON, though? And I think that's a fair question to ask, because there's so many shoe brands out there, so many. I just put a few of them. I'm not a runner, but I just put a few of them that I know, like Oka or Brooks. I mentioned Asics earlier. There's so many brands. So what makes this brand so special? Well, I mean, in a nutshell, the answer is that I don't know what makes it so special. They of course claim to have a unique technology that they call the on-cloud technology, which is why the company is called ON. By the way, it's running on cloud, like running on a cloud tech. That's their own marketing. That's why it's called ON. But I can't confirm that the technology is better than the best. In fact, so many running shoes try to push their tech and say that they're the best. So I'm not sure they have that big of an advantage. What I know, though, is that this is going to be one of the players that is stealing market share from the sleeping giant that is Nike. And I could have thrown Adidas in there, right? These sleeping giants, they're being attacked. They're losing market share by a whole bunch of neo brands. This is the same story as when I talked about beauty stocks a month ago. You have L'Oreal being attacked by Elf and by Oddity, all of these new beauty brands. Neo brands attack existing brands, and I believe they have their fair shot at taking business away from these existing brands. So I'll finish talking about what interests me the most, of course, and the main reason why I cover this company is the numbers. The company is cheap. It's very cheap, in my view, at a 0.147. So enterprise value is 8.9 billion, and my enterprise value over gross profit, over revenue growth, which is my favorite metric, the best way that I assess stock, gives me a 0.15. So we are getting into into the first quartile, even perhaps the first decile of cheapest stocks that I cover on the channel. That's a very impressive number right there. This is, by the way, my spin on the peg ratio. I want this number to be as low as possible, and this one is not quite like a HIMS or a StoneCo, but pretty close to a StoneCo. So that's pretty dirt cheap. Analysts, I'm using analyst data here for revenue growth. They're predicting 52% revenue growth. And as far as gross margin numbers and EBITDA margin numbers go, I am using the numbers that were mentioned directly by the CEOs in the latest transcript that I listened to. So these are not the numbers you'll find on Seeking Alpha. These are the numbers mentioned on the latest call that took place in early January. So that would be 60% gross margin and 18% EBITDA margin, which is excellent. It's excellent that we have a positive EBITDA margin for such a young company. Like, this is great. So if you add 18% plus 52%, you get a rule of 70 on this stock, which is outstanding. The classic way to think about this is a 40 is good. When you add EBITDA margin, how much money you actually make, right? How much cash stays with the business, and you add the growth rate. When you add both of these, the goal really in quote unquote SaaS investing, rule of 40 investing, is to get at least 40. Here we get a 70. That's to me is a very appealing stock. So is the stock a buy for me? And let me answer this question very, very, very simply. First of all, it's definitely a buy for my he must do portfolio, where I play and I buy stocks just because it's a hobby and I love stocks. So it's definitely a target for that. And I think this is a stock that could go really well in a lifestyle brand portfolio or in a neo brand portfolio. Understand company like Celsius Holdings, like Figs. Figs is kind of trying to make scrubs, medical scrubs mainstream, and that would be ON, right? That would be a good fit, in those lifestyle stocks. So So yes, from that standpoint, it'll be a buy. Am I buying the stock though? And this is the question. Well, I like the stocks at these levels. I think it's very interesting. But as long as IMS is trading in the $8 range, as long as Enphase is around $100, and as long as Tesla is around $200 and Bitcoin about $40,000, I'm gonna prefer these assets. So my funds are heavily targeting these four right now, and there's probably a few more that I'm also buying right now, but ancillary positions is not my priority right now when Tesla is trading at 206, right? It's not a priority, but nonetheless, if these stocks were not that cheap, or if my favorite stocks were to go up in value, like I think they will, and this company lags, then I would start a position for my EMS 2 or something portfolio, and that's typically how I do it. I typically don't take a full position in a stock unless I really get to know the stock really, really, really well. And this is a first time video on this stock, first time in-depth analysis. So anyways, wanted to make a quick video about it tonight. I hope you like the video. Thank you for watching. This is, by the way, just entertainment. No investment advice, no financial advice. Thanks for watching. Please subscribe. Follow me on Next if you can, and have a wonderful day. Thanks.